What's up, future insurance pros? Welcome back to the channel. If you crushed set 1, you are ready for the next level. Today, we are diving straight into set number 2 with 39 highly tested practice questions designed to get you exam ready. I'm bringing the energy today, and I need you to bring the focus. Grab your notepad, smash that subscribe button, and let's get you one step closer to passing your exam. Let's go! Question 22. A blank rider allows a policyholder to add term insurance coverage for their spouse. A. Disability income. B. Spouse or other insured term. C. Waiver of premium. D. Accidental death. The correct answer is B. Spouse/other insured term. Question 23. A payor benefit rider is most commonly associated with which type of life insurance policy? A. Whole life insurance policies. B. Universal life insurance policies. C. Juvenile life insurance policies. D. Term life insurance policies. The answer is C. Juvenile life insurance policies. The payor benefit rider is primarily linked to juvenile life insurance policies. It ensures that if the premium payor, often a parent or guardian, becomes disabled or dies, the premiums are waived until the child reaches a certain age. This rider is less common in whole life, term life, and universal life policies. Question 24. Juvenile life insurance policies are usually owned and paid for by A. The minor's employer. B. An adult, typically a parent or guardian. C. The minor. D. The state government. The correct choice is B. An adult, typically a parent or guardian. Juvenile life insurance policies are typically owned and paid for by an adult, such as a parent or guardian. This allows the adult to manage the policy and ensure it remains in force until the child is old enough to take over. The minor, the minor's employer, and the state government do not typically own or pay for these policies. Question 25. Linda owns an indexed life insurance policy linked to the S&P 500. If the index experiences a 10% increase, which of the following statements best describes the effect on Linda's policy? A. The cash value increases, but not beyond the policy cap. B. The policy automatically lapses. C. The premiums increase. D. The death benefit decreases. The correct answer is A. The cash value increases, but not beyond the policy cap. In an indexed life insurance policy, the cash value is tied to the performance of a specific index, such as the S&P 500. If the index increases by 10%, the policy's cash value will also increase, subject to a cap set by the policy. This cap limits the maximum rate of return, providing growth potential while also protecting against significant market downturns. A. The death benefit decreases is incorrect, as the death benefit typically does not decrease due to index performance. C. The premiums increase is incorrect. Premium amounts are generally fixed or flexible, not influenced by index performance. D. The policy automatically lapses is incorrect. Index performance does not cause policy lapse. Question 26. The spendthrift clause in a life insurance policy is designed to A. Ensure the beneficiary cannot squander the proceeds. B. Allow the insurer to change the beneficiary. C. Increase the cash value of the policy. D. Protect the policyholder from creditors. The correct answer is A. Ensure the beneficiary cannot squander the proceeds. The spendthrift clause protects the policy proceeds from being squandered by the beneficiary by preventing them from being claimed by creditors and limiting their ability to pledge or assign the proceeds. This ensures that the funds are used as intended by the policyholder. Protecting the policyholder from creditors, allowing the insurer to change the beneficiary, and increasing the cash value of the policy are not the purposes of the spendthrift clause. Question 27. A policyholder has a blank day grace period to pay overdue premiums before their life insurance policy lapses. A. 30. B. 60. C. 45. D. 15. The correct answer is A. 30 days. A policyholder has a 30-day grace period to pay overdue premiums before their life insurance policy lapses. This period allows the policyholder to make the payment without losing coverage. Grace periods of 15 days, 45 days, or 60 days are not the standard minimum required by Georgia law. Question 28. What is the purpose of a waiver of premium rider in a life insurance policy? A. To extend the term of the policy. B. To waive the policy's premium if the insured becomes disabled. C. To increase the death benefit amount. D. To cover the policy loan interest. The right answer is B. To waive the policy's premium if the insured becomes disabled. The waiver of premium rider ensures that if the insured becomes disabled and cannot work, their life insurance premiums are waived, keeping the policy active without additional cost. This rider does not increase the death benefit, cover policy loan interest, or extend the term of the policy. Question 29. It is crucial for the agent to explain blank to the client when delivering the policy. A. Policy provisions, riders, exclusions, and ratings. B. The underwriting process. C. The future investment opportunities. D. The history of the insurance company. The answer is A. Policy provisions, riders, exclusions, and ratings. When delivering the policy, it is essential for the agent to explain the policy provisions, riders, exclusions, and ratings to ensure the client fully understands the coverage, any additional benefits, and limitations of the policy. Explaining the underwriting process, the history of the insurance company, or future investment opportunities are not as directly relevant to the immediate understanding and effective use of the life insurance policy. Question 30. The blank rider provides a benefit in case the insured dies due to an accident. A. Long-term care. B. Accidental death. C. Disability income. D. Critical illness. The correct choice is B. Accidental death. The accidental death rider offers an additional death benefit if the insured dies as a result of an accident. This rider can provide extra financial protection for beneficiaries. Disability income, critical illness, and long-term care riders provide different types of benefits related to disability, illness, or long-term care needs, rather than accidental death. Great job making it through the first 10. Take a deep breath, stretch if you need to, and let's keep this momentum going with question 31. Question 31. How can dividends be used to lower future premium payments? A. By selecting the reduction of premium payments option. B. By taking the dividends as cash. C. By choosing the accumulation at interest option. D. By purchasing one-year term insurance. The answer is A. By selecting the reduction of premium payments option. Question 32. In an ordinary whole life policy, the cash value is guaranteed to equal the death benefit at what age of the insured? A. 95. B. 70. C. 65. D. 100. The correct answer is D. 100. In an ordinary whole life insurance policy, the cash value is designed to grow steadily and is guaranteed to equal the death benefit at the insured's age 100. This means that if the insured lives to age 100, the policy will endow, and the cash value will be paid out to the policyholder, effectively functioning as a living benefit. A, 65, B, 70, and D, 95, are not the standard endowment ages for ordinary whole life policies, which are specifically designed to mature at age 100. Question 33. Which statement best describes third-party ownership of a life insurance policy? A. It is when the policy owner and the insured are the same person. B. It is the situation where the insurance company owns the policy and the insured is the beneficiary. C. It refers exclusively to policies owned by charitable organizations. D. It involves an entity other than the insured owning the policy. The answer is D. It involves an entity other than the insured owning the policy. Third-party ownership means that the policy is owned by someone other than the insured person, such as a business or a relative. This can be useful in various scenarios, such as business partnerships or estate planning. The insurance company owning the policy owner and insured being the same person, and ownership exclusively by charitable organizations are incorrect descriptions of third-party ownership. Question 34. Who typically has the right to change the beneficiary on a life insurance policy? A. The insured. B. The policy owner. C. The insurance company. D. The primary beneficiary. The correct choice is B, the policy owner. The policy owner generally has the right to change the beneficiary designation on a life insurance policy. This control allows the policy owner to adjust the beneficiary as circumstances change, such as changes in family dynamics or financial planning needs. The insurance company, the insured, and the primary beneficiary typically do not hold this right, unless specified otherwise in the policy. Question 35. Public adjusters must secure a surety bond as part of their blank. A. Licensing criteria. B. Employment contract. C. Continuing education. D. Insurance coverage. The answer is A. Licensing criteria. Public adjusters must secure a surety bond as part of their licensing criteria. This bond provides a financial guarantee that the adjuster will perform their duties ethically and according to the law. Unlike employment contracts, continuing education, or insurance coverage, the surety bond is specifically tied to licensure. Question 36. Pay attention to the specific numbers on this one. Tom, a surplus lines broker, must collect a specific premium tax on surplus lines insurance and submit it to the state. What is the percentage of this tax? A. 2%. B. 4%. C. 3%. D. 5%. The correct answer is B. 4%. In Georgia, surplus lines brokers like Tom must collect a 4% premium tax on surplus lines insurance and submit it to the state. This tax helps regulate and manage the surplus lines insurance market. Rates of 2%, 3%, or 5% are incorrect. Question 37. The proceeds of a life insurance policy paid to a beneficiary due to the insured's death are A. Generally tax-free. B. Subject to income tax but exempt from estate tax. C. Fully taxable as income in the year they are received. D. Taxable if they exceed a certain amount. The answer is A. Generally tax-free. The death benefit from a life insurance policy is generally tax-free to the beneficiary. This means that the lump sum received upon the insured's death is not subject to federal income tax. Taxable if they exceed a certain amount, subject to income tax but exempt from estate tax, and fully taxable as income in the year they are received are incorrect, as they do not reflect the standard treatment of life insurance death benefits under U.S. tax law. Question 38. What does a joint life insurance policy, also known as a first-to-die policy, primarily insure? A. It provides a death benefit only after both insured individuals have passed away. B. It pays out the death benefit after the first insured person dies. C. It accumulates cash value at a higher rate than individual policies. D. It allows for the transfer of policy ownership without tax implications. The correct choice is B. A joint life insurance policy, or first-to-die policy, provides a death benefit payout upon the death of the first insured person. This helps ensure financial support for the surviving insured individual or their beneficiaries. Providing a death benefit after both insured have passed away and accumulating cash value at a higher rate are not features of first-to-die policies. Transferring policy ownership without tax implications is unrelated to the primary purpose of this policy type. Question 39. What is the primary purpose of juvenile life insurance? A. To cover burial expenses for minors. B. To protect the child's future insurability. C. To provide retirement benefits. D. To offer investment opportunities. The answer is B. To protect the child's future insurability. Question 40. An agent's license in Georgia must be renewed every blank years. A. 4. B. 3. C. 2. D. 1. The correct answer is C. 2 years. In Georgia, an agent's license must be renewed every 2 years. This renewal cycle helps ensure that agents remain up to date with regulatory changes and continuing education requirements. Renewal periods of 1 year, 3 years, or 4 years are incorrect for the state's licensing requirements. Question 41. Which of the following statements about the taxation of individual life insurance premiums is correct? A. Premiums are tax-deductible for the policyholder. B. Premiums are usually not tax-deductible. C. Premiums are always tax-deductible if the policyholder has dependents. D. Premiums are tax-deductible only if the policyholder is a business entity. The answer is B. Premiums are usually not tax-deductible. Generally, premiums paid for individual life insurance policies are not tax-deductible for the policyholder. This is a standard tax rule, except in certain situations, such as when the premiums are paid by a business for key person insurance. Tax-deductible premiums and always tax-deductible if the policyholder has dependents are incorrect, as they do not apply to individual life insurance policies. Tax-deductible only if the policyholder is a business entity applies to specific business-related policies. Question 42. The insuring clause in a life insurance policy, A. Lists the various exclusions that apply to the policy. B. Details the obligations of the insurance company to pay the death benefit upon the insured's death. C. Defines the rights of the policy owner. D. Specifies the premium payment schedule. The correct choice is B. Details the obligations of the insurance company to pay the death benefit upon the insured's death. The insuring clause is a fundamental part of a life insurance policy that outlines the insurer's promise to pay the specified death benefit to the designated beneficiaries upon the insured's death. This clause establishes the core obligation of the insurance company, provided all policy conditions are met. It does not cover the premium payment schedule, list policy exclusions, or define the rights of the policy owner. Question 43. When does an insurance contract become valid? A. After the first claim is made. B. When the insurer accepts the offer by issuing the policy as requested. C. When the applicant fills out the application form. D. When the insurer delivers the policy. The answer is B. When the insurer accepts the offer by issuing the policy as requested. An insurance contract becomes valid when the insurer accepts the applicant's offer by issuing the policy as requested. This acceptance forms a binding agreement between the insurer and the insured. Filling out the application form, delivering the policy, and making the first claim do not constitute the official formation of the contract. Question 44. Which of the following policies combines investment options with flexible premiums and a guaranteed minimum death benefit? A. Single premium life. B. Variable universal life. C. Term life insurance. D. Ordinary whole life. The correct answer is B. Variable universal life. Question 45. If the primary and contingent beneficiaries die from a common disaster, the policy proceeds will go to the A. State's unclaimed funds. B. Insurer's general fund. C. Named tertiary beneficiary. D. Estate of the primary beneficiary. The answer is C. Named tertiary beneficiary. If both the primary and contingent beneficiaries die in a common disaster, the policy proceeds are directed to the named tertiary beneficiary. This ensures that the benefits are distributed according to the policyholder's wishes, rather than defaulting to the estate or other undesignated entities. The estate of the primary beneficiary might receive the proceeds in the absence of a tertiary beneficiary, but this is not the preferred option. State's unclaimed funds and insurer's general fund are incorrect, as they do not align with standard beneficiary designations. Question 46. Group life insurance is typically offered by blank to provide coverage for their employees. A. Employers. B. Families. C. Nonprofit organizations. D. Individual policyholders. The correct answer is A. Employers. Group life insurance is typically offered by employers to provide coverage for their employees as part of an employee benefits package. This coverage is generally more affordable and accessible than individual policies. Families, nonprofit organizations, and individual policyholders are not the primary providers of group life insurance. Question 47. Which of the following must sign a life insurance application? A. The person insured only. B. The insurance agent only. C. The insurance agent, the person insured, and the policy owner if different from the insured. D. The beneficiary. The answer is C. The insurance agent, the person insured, and the policy owner if different from the insured. A life insurance application must be signed by the insurance agent, the person insured, and the policy owner if they are different from the insured. This ensures that all parties involved in the policy have agreed to the terms and conditions. The insurance agent only, A, the person insured only, B, and the beneficiary, D, are insufficient for completing the application process. Question 48. Lucy, an agent, is found guilty of false financial reporting about a competitor. What term describes this unethical practice? A. Twisting. B. Rebating. C. Churning. D. Defamation. The correct choice is D. Defamation. Lucy's act of false financial reporting about a competitor is considered defamation. This unethical practice involves damaging the reputation of another party through false statements. Twisting refers to misleading policyholders to switch policies. Churning involves unnecessary policy replacements for commission, and rebating is offering unapproved incentives to clients. Question 49. What are the essential elements required for a contract to be enforceable? A. Duration, cost, risk assessment, and termination clauses. B. Documentation, notarization, witness signatures, and legal review. C. Beneficiary details, policy terms, exclusions, and amendments. D. Consideration, legal purpose, offer and acceptance, competent parties. The answer is D. Consideration, legal purpose, offer and acceptance, competent parties. For a contract to be enforceable, it must include consideration, something of value exchanged, a legal purpose, compliance with the law, offer and acceptance, mutual agreement, and competent parties, individuals with the legal capacity to enter a contract. Duration, cost, risk assessment, and termination clauses, beneficiary details, policy terms, exclusions, and amendments, and documentation, notarization, witness signatures, and legal review are important, but not the fundamental elements required for contract enforceability. Question 50. Which factor is not typically considered when conducting a personal insurance needs analysis? A. Current income levels. B. Number of dependents. C. Favorite hobbies. D. Current employment status. The correct answer is C. Favorite hobbies. Favorite hobbies are generally not a significant factor in a personal insurance needs analysis. This analysis focuses on aspects that affect financial needs, such as current income levels, number of dependents, and current employment status. These factors help determine the amount of coverage needed to support dependents and maintain the policyholder's standard of living in case of an unexpected event. Question 51. Mike has a life insurance policy with a facility of payment clause. He dies without naming a beneficiary. Who is likely to receive the death benefit? A. The state government. B. A person or entity chosen by the insurer. C. His creditors. D. The insurance company. The answer is B. A person or entity chosen by the insurer. Question 52. Renewal commissions may still be received by unlicensed individuals if the sales were made when they were blank. A. Registered. B. Licensed. C. Employed. D. Contracted. The correct choice is B. Licensed. Unlicensed individuals can still receive renewal commissions if the sales were made when they were licensed. This rule applies to ensure agents can continue to benefit from their previous work. Receiving commissions while being employed, contracted, or registered is not applicable unless they were licensed at the time of the sale. Question 53. What demonstrates insurable interest in the context of life insurance? A. Casual friendship with the insured. B. Being friends with the insured on social media. C. Expecting financial loss due to the insured's death. D. A professional acquaintance with the insured. The answer is C. Expecting financial loss due to the insured's death. Insurable interest exists when the policyholder stands to suffer a financial loss or hardship from the insured's death. This is a fundamental requirement for purchasing life insurance to ensure that the policy is based on a legitimate financial interest. Being friends on social media, a professional acquaintance, and casual friendship do not establish the necessary financial dependence or loss to demonstrate insurable interest. Question 54. The blank exclusion is commonly found in life insurance policies and denies coverage for deaths resulting from the insured's participation in an aviation event not as a fare-paying passenger. A. Aviation. B. Occupational hazard. C. Hazardous activity. D. Military service. The correct answer is A. Aviation. The aviation exclusion in life insurance policies typically denies coverage for deaths resulting from the insured's participation in aviation activities, such as piloting or crew duties, unless the insured is a fare-paying passenger on a commercial flight. This helps manage the insurer's risk associated with high-risk activities. Hazardous activity, B, military service, C, and occupational hazard, D, exclusions cover different specific risks. Question 55. Which non-forfeiture option continues coverage with a reduced death benefit and no further premiums required? A. Extended term insurance. B. Reduced paid-up insurance. C. Accumulation at interest. D. Cash surrender value. The answer is B. Reduced paid-up. The reduced paid-up insurance option allows the policyholder to use the existing cash value to purchase a paid-up policy with a lower death benefit and no further premium payments required. This maintains some level of coverage without ongoing costs. Cash surrender value provides a lump sum payment, extended term insurance uses the cash value to buy term insurance, and accumulation at interest is not a non-forfeiture option. Question 56. What is required for someone to have an insurable interest in another person's life insurance policy? A. A casual acquaintance. B. Living in the same neighborhood. C. Being friends on social media. D. A substantial economic interest in the continued life of the insured. The correct choice is D. A substantial economic interest in the continued life of the insured. To have an insurable interest in another person's life insurance policy, there must be a substantial economic interest in the continued life of the insured. This requirement prevents speculative policies and ensures the policyholder would suffer a genuine loss if the insured dies. Casual relationships, like a casual acquaintance, being friends on social media, or living in the same neighborhood, do not qualify. Question 57. What does a level term life insurance policy offer? A. A death benefit that varies based on market performance. B. An increasing death benefit over the term of the policy. C. A constant death benefit over the term of the policy. D. A decreasing premium over the term of the policy. The answer is C. A constant death benefit over the term of the policy. A level term life insurance policy provides a fixed death benefit that remains the same throughout the term of the policy. This stability makes it a straightforward option for policyholders seeking consistent coverage. An increasing death benefit and a death benefit that varies based on market performance describe other types of life insurance, while a decreasing premium is not typical for term policies, which usually have level premiums. Question 58. In a survivorship life policy, also known as second to die, when is the death benefit typically paid out? A. After both insured individuals have passed away. B. When the surviving policyholder reaches a certain age. C. Immediately after the first policyholder dies. D. It varies based on the terms set by the insurance company. The correct answer is A. After both insured individuals have passed away. A survivorship life policy, or second to die policy, pays the death benefit only after both insured individuals have died. This is often used for estate planning purposes, to provide funds for estate taxes or to leave an inheritance. Paying out immediately after the first policyholder dies, and when the surviving policyholder reaches a certain age, are not characteristics of second to die policies. The payout timing does not vary based on the insurance company's terms. Question 59. Which of the following is a characteristic of group life insurance? A. Higher premiums for older employees. B. Mandatory medical exams for all employees. C. Coverage for all eligible members under a single contract. D. Individual underwriting. The correct answer is C. Coverage for all eligible members under a single contract. And here is our final question for this video. Question 60. Which of the following is a characteristic of group life insurance? A. Mandatory medical exams for all employees. B. Higher premiums for older employees. C. Coverage for all eligible members under a single contract. D. Individual underwriting. The correct answer is C. Coverage for all eligible members under a single contract. This is a key characteristic of group life insurance policies. Group life insurance is designed to cover a group of people, usually employees, under one master contract issued to the employer or organization. Boom! 39 questions in the books! Give yourself a massive round of applause for pushing through that set. Now, it's accountability time. How many did you get right? Drop your score in the comments right down below so we can celebrate your progress. If this video brought you value, do me a favor and smash that like button. Subscribe to the channel and keep grinding. I will see you in set 3.